Hello traders, this is Dr. H, and this is the first video of a series that cover option basics. So we will start from the very beginning in order to help fresh beginners to start learning about options and get into this subject. So in this video we'll talk about what are calls and puts. So these are the basic notions in option trading. Basically you're dealing with calls and puts all the time if you're trading options. So first of all, calls and puts, they are contracts. Buyers can exercise the rights, sellers have obligations. Three most important parameters are expiration, strike price, and premium. And the expiration is when the contract expires. The premium is the cost of the contract. Basically, this is the cost that you see in your broker. It's the price that's printed. For example, sometimes you want to buy some call contract and you see $1.5. That's basically the premium. Strike price, and we'll see later. So a call contract grants the owner the right to buy 100 shares at the strike price before the expiration. A put contract grants the owner the right to sell 100 shares at the strike price before the expiration. So as an option buyer, you have the right to do something, but if you're selling options, you have the obligations to fulfill those rights exercised by the buyers. So if these things are too dry, we will see very soon some real-world examples and some backtests. So first of all, keep in mind, calls and puts can be used for either hedging or speculations. And speculations are literally just betting on the stock going up or down, and these are very common usage for especially us retail traders. Sometimes online you can see a lot of traders post screenshots of massive profits, and usually it's done by buying calls and puts, etc., at the right moment. But they don't happen all the time. So the second point you have to keep in mind is that you will see later that buying calls and puts too often is generally not a good idea. Okay, so let's take a look at some real examples. So for example, if you trade SPY, and right now SPY is trading at 450-ish. So if you want to buy a call option with the expiration November 12th, this vertical line here, the strike price is $460, which is up here. And the premium is $1.52. So there's one important thing that I have to clarify. So usually the premium is on a per share basis, those numbers that you see in your broker. But remember, a call option grants you the right to buy 100 shares. So basically, if you want to compute the cost of one contract of call, you have to multiply the premium by 100. So what you get here is $152 per contract. That's a very confusing point. I remember when I got started, when I first downloaded Interactive Broker, I got extremely confused by those numbers. I was thinking, oh, they're so cheap. How can they be so cheap? I just buy, sometimes I buy like 420 calls, but it's already trading at 450 and it costs like, what, $20? No way. Things like that. So this is the first thing I have to clarify. You have to multiply by 100, extremely important. And secondly, let's take a look at a few examples. For example, so first of all, a call expires on November 12th in our case. So let's look at some examples of things that can happen between right now and the expiration. For example, if we rally like this, and we eventually closes at 475 for computation's sake. Let's take 475. So if at the expiration date, if you are still holding this call option, you can literally just exercise your right to buy 100 shares of a SPY down here at 460. That's the definition of the call contract. And then once you buy 100 shares, you can directly sell to the market at a higher price. So that makes you book a 1,500 profit because you have 100 shares, and this is $15 per share of profit. So that's 1,500. And initially you paid 155 for this contract. So your net profit is 1,500 minus 152. So that's gonna be 1,348. So that's actually a massive return. So that's why this is so attractive to some people, because if you buy at the right moment and the correct thing happens, you can book like 10 times return, almost 10 times. So yeah, that's the call. And for the put, if you're buying a put option with the same expiration, November 12th, in this example, and the strike price is 440, which is down here, and the premium is probably going to be $2.52 per share. So you have to pay $256 for one contract of put option. And if you're holding this put option and at expiration it tanks like this, let's say it tanks to 430. So you can basically sell 100. So first of all, you could just buy 100 shares from the market for 430. But remember, the put option allows you to sell at a higher price of 440. So you can directly sell it to put sellers. So by doing so, you booked a $10 per share profit, and that's a $1,000 profit, minus the initial cost, which was $256. So that's a 744 net profit. So that's also very good. That's almost 3 times. So as you can see, this is an attractive situation, but there's another case that could happen. For example, SPY trades sideways like this, and it expires at the expiration date. It still trades at 450. So now, in this case, for this call option, there's no point of exercising the right because it's below the strike price. Therefore, your call option is worthless, and you wasted your premium that you paid initially. You wasted $152. For this put, since the price is above the strike price of 440, this is also worthless, and you wasted your $256 per contract. So these are the two scenarios, and a lot of people think it's very attractive because risk reward is very, very high. But as we can see later, this might be a trap in some cases. So now here, this is a backtest result. So basically this backtests the idea of buying weekly calls every single day at open and sell at close. So by weekly calls, I mean the expiration date is within the same week, or just on Friday. So if you buy at open, sell at close, you can see it goes down steadily. And the backtest started in 2019 and ends at 2021. And this was the COVID drop. This was 2020 March. Well, that was reasonable, but if you remember SPY, if you remember the general market, we had a really, really nice recovery rally, and at some point here, we were back to the all-time high. However, as you can see, we are still going down, and the rally here in the summer didn't even make up for half of the loss during the COVID time, and then we just continue going down and down and down. So as you can see, this is actually not a good idea. And this is just a proof of concept. And basically, if you buy weekly calls very, very often, you're going to lose money like that as well. Unless you're extremely lucky, like you bought here, sell here, bought here, sell here. I mean, sometimes it works, but I think for most of the people, we're not that lucky. So actually, a lot of sophisticated traders, they even use weekly calls to day trade. By recognizing those patterns, double bottoming versus head and shoulder, they probably have a small account. They can't afford the shares, so they just buy some calls to trade. And sometimes I still get the questions like, why am I losing money on my calls despite the share going up? So that's probably because that you're paying for the decay of a price. This is called Theta Decay, and this is another complicated subject that we are not going to cover today. But the basic idea is that options lose money over time. And the reason is that people's expectations diminish over time. So for monthly puts, it's pretty much the same story. I have another back test right here. Basically, we're buying monthly at the money puts. And usually for monthly options, you have 10 days, 20 days before the expiration. So you have a bit of more time between the purchase date and the expiration date. Despite having a bit time, you are still going down, and that's a combination of two reasons. One is the theta decay. The other one is that the SPY keeps going up. But if the market has some kind of dramatic drop, like in 2018 in February, there was some kind of very sharp drop, if you remember. So basically, you could almost make up for what you lost in the past year. Well, at least this is better than that, right? Here, better than the previous one. Here, I mean, the recovering rally doesn't even make up half of the loss here. So if you have a bit more time, things become more manageable. Sometimes you can make up your loss. It's not as bad, but it's still bad. So generally speaking, if you do more back tests, it's always like that. And if you purchase calls and put, unless your timing is extremely right, otherwise you're probably not going to be very profitable. And that's why sometimes we have complicated spreads. Sometimes when you buy an option, you have to sell another one to hedge certain parameters, but that's very complicated. We will talk about those briefly in the next and the following videos. So for today, this is enough, and thank you for watching. Stay tuned. Thank you so much for checking out this video. Remember, this is only for educational purpose and not intended as financial advice. Feel free to hit the subscribe button and turn on notifications so that you won't miss our new content. Please also check out our website and visit our membership page. The current launching deal is £59 per month, which is cheaper than a cup of coffee every day. You can save more by subscribing for 6 months or a year for extra consultations and coaching sessions. Our Discord server is available without membership subscriptions. Our membership subscription includes trading rooms on forex trading, swing trading, fundamental analysis, and algo trading. It also includes the access to our global Slack community, where you can chat with traders from all over the world. We have the main channel, the future channel, the crypto channel, swing trades, option trades, day trades, and a lot more. Thanks for watching, and love, live, live, and trade it. See you in the next video.